And we're back today with another Can I Retire episode. And today we've got JR and Sue Ellen hypothetical. If we haven't met, my name's Tony Hansman. I'm the president of Guardian Financial. We're a wealth management firm, and we do these case studies to give you ideas of what you should be thinking about as you're in or nearing retirement. We go from this accumulation phase into this preservation stage, and I want to show you this case study so you can relate it to your own situation. So don't get always caught up in the numbers, but here we go. You can see here we've got JR. He works for company ABC, and he's doing well for himself. He's got about $350,000 of income, and he wants to retire. He's currently, him and his wife, Sue Ellen, are the age of 60, and they want to retire in 5 years from now at the age of 65. Sue Ellen's working. She's doing well, too. She makes another $250,000, so about $500,000 of income coming in. And you can see down here that JR, his primary Social Security is about $4,000 a month, and Sue Ellen's will be about $2,500 a month. Now, I've got a little bit of cost of living adjustment for their Social Security, but I am being very conservative. Over here on our COLA history, you can see the 10-year average has been about 2.83%, and over the last 51 years, it's been 3.67. If you take a look, though, I'm only giving them credit for 2.5. So again, being very conservative there. Now I'm going to go over their assets. Let's take a look at how much money that they have. You can see on line 1, JR has, let's see if we got this highlighted here, a 401k, and he's got $2 million in his current 401k. And a lot of it is all in target funds. And let me just tell you from the very get-go, if you know me, if you watch any of my other videos, I'm not a big fan of target funds at all. They're easy to get into, but I can show you statistically that they have underperformed in the past. I just like other things. So Sue Ellen's got a 457, and she's got about $650,000 in that account. They have a brokerage account with about $650,000. That's after-tax money. And then they each have Roth accounts, and they each have about $100,000 each in their Roth accounts. Now, those are diversified in mutual funds, and again, just so happens, I'm not a big fan of mutual funds either. I think mutual funds are the thing of the past. I believe they're dinosaurs, and I think there's other things that are much more efficient that you can be using in retirement. So if you have mutual funds, this is not a plug for my book, but just reach out to us. We'll even send you a free copy of it. But I give all the rhyme and reasons of why you need to get out of mutual funds much sooner than later. So if we move down, you can see here that they have a house. The house is worth about $1.5 million, and that gives them a total net worth of $5 million. So $3.5 million in liquid assets and $1.5 in home. Now they say, hey, Tony, we'd like to live off, we think, about $20,000 a year after taxes when we retire. So we're going to drop that number in right here. Now this is just a 30,000-foot overview. If I wanted to get technical, which I would literally list out all of their expenses and be much, much more detailed in this plan. But this is just a hypothetical case, and I want this not to be a 50-minute video, but about a 10-minute video. So I'm using an average inflation of 3.27%. That's simply from my inflation calculator here that says over the last 110 years, it's been 3.27. I know we could argue that one all day long. If you want to, let's have that conversation. But for now, we're going to leave it at 3.27. You want it to be higher? Happy to run it that way for you. Move over to our cash flow tabs. You can see they've got a rental income, and they got a rental house, and they get about $2,500 a month. Rental house is paid for free and clear. So we're just going to give them that income for the rest of their life. They say that they're going to keep it, so we're going to leave it that way. So the big three concerns that they have, like many people that I talk to in or near retirement, is one, income. Tony, I don't have an income plan. Can you please just make sure we're never going to run out of money and not be a burden on the people that we love the most? Number 2, investments. We want to make sure we're getting the greatest returns with the least amount of risk and the lowest cost possible. Again, I'm not a big fan of target funds, and I'm definitely not a fan of mutual funds. And then number 3 is tax planning. And this is where most people are not getting help from their current CPA or accountant or whoever's doing their current tax returns or their current financial advisors. And I'm a nerd. I love this stuff. And that's why I wrote this book called The 10 Tax Commandments. So what we're going to do is we're going to implement with just one simple strategy that's in this book right here in front of you, so you can take a look at how it's going to save this particular case study, this couple, JR and Sue Ellen, some money. So if I go to the retirement tab, the first thing that we want to look at is do they have enough money to live off of? Because that's number 1, income planning. So if I take a look right here at the age of 95, they've got about $4.1 million in liquid assets, right? Plenty of money at the end of their life in their 90s. So I'm not too worried about their income. But let's break it down for those of our engineer people watching who want to see where the money's coming from. So if I come down here at the age of 65, that's the year they're both going to retire. Again, they're 60 now. 5 years from now, they're going to retire. And their Social Security income looks like this. About $6,600. Let me click this off over here, and then it's going to show you the breakdown of that. So $4,000 in Social Security for JR, and about $2,692 in Social Security for Sue Ellen. And then with that cost of living, remember, I didn't give it a big dollar growth each year, but a small cost of living, you can see it going up to $6,800, then $7,000, then $7,200, then $30,000. So that's the cost of living adjustment over those years. And then this column represents that rental income. Remember, at 60, it's $2,500, but I give it a little bit of increase each year, and you can see that rental income at the retirement is $2,760, and that slowly goes up with inflation as well, okay? And then add those two lines up, you can see we've got the Social Security and that rental property of about $9,000, but even though they wanted $20,000 in today's mindset, in 5 years from now, believe it or not, that's going to feel more like $24,194 because that inflation's kicking in, right? So that means I have to pull out $15,000 per month out of their assets. And their assets column is right over here. So the very last line where it says $5.4 million, and you can see $3 million in their target funds or their 401k, $1.1 million in the 457. The joint brokerage account is now up to $988. You can see those accounts growing. And you can see that happening every single year. If I go, I'm just going to go this slowly so you can see this. Second year, you can see the accounts are still growing. $5.7 million to $5.8 million to $6 million, even when we're still pulling out $15,000 a month. And the reason it's $15,700 the next year and $16,000 the next year and almost $17,000 next year is because that inflation factor. We certainly don't want to forget inflation. We need to include that in the plan to make sure they're not going to outlive the money. So if I scroll down here all the way down to she thought she's going to live to her 90s. So we ran this out to about 95. She still has $4.1 million. Now, the third thing that she stressed to me is taxes. She says, Tony, I'm not getting any help with taxes. A lot of other guys I talk to, they don't help with the tax side of it. And I said, well, I'm a nerd. I wrote a book. I loved talking about taxes. I am not tax licensed. I work with professionals who are, and then we design a case to help families save taxes. So let's do an easy tax deal here in a second, but let's first go out and stress test this portfolio that they're currently in. Because you have to understand two important things is when you are in the accumulation phase of still working, right? We can put the pedal to the metal and keep growing this thing. But as we move into retirement, we want a little bit of preservation as well because of what we call the sequence of returns. So you saw on my retirement tab that at age 95, she has $4 million. JR and Sue Ellen, they both do. However, if they retire and in the first 2 or 3 years, the stock market's down and they are pulling money out of those accounts, that can be devastating to a retirement plan. So take a look at this. This is if in the very first year they retired, the portfolio's down 10% and they're pulling out $15,000 a month, almost $200,000 a year, right? And then the next year it's down 13% and they're still pulling all that money out. And then the next year, it's down 23%, and they're still pulling all that money out. What happens? Well, I'll tell you, it's not good. They get redlined or they're out of money at the age of 84, much, much quicker than what they want to be. So what's the solution? We want to have a couple different buckets here. A growth bucket that's continuing to grow for them for the long run, that does have market volatility and risk and go up and down, but a protection bucket is ideal. So when the stock market's down, we can reach out to that protection bucket and take withdrawals from those accounts and let the growth bucket rebound. You don't want to be taking huge withdrawals out, and the market's down at the same time, especially if it happens 2 or 3 years in a row. Again, it can be devastating. So sequence of returns is vital. Somebody's got to be having their arms around this portfolio and be talking to you 2, 3, 4 times a year and making sure that all is working smoothly. So you can see this person who doesn't have a protection bucket, draws that kind of money out, is not paying attention to it, runs out pretty darn quick. So we're going to pretend that you did a protection bucket and you're fine. You don't have to worry about it. So now let's go to what this customer's biggest concern is JR and Sue Ellen. They're like, Tony, I get it. Growth, protection, I'm in on that deal, but taxes. What are we going to do on taxes? So I got a tax tab right here. This is simply a 30,000 foot view. I've got 2 or 3 other softwares that I really like to use. This is just my most basic one to keep it simple for you to understand and to show you. Is I'm going to go across this line right here, and you can see that in qualified money, they've got about $2.6 million. Non-qualified, $650,000. In Roth money, about $200,000. Well, many people forget that when you're in your 70s, whether you like this or not, Uncle Sam's going to come knocking at your door and you're going to have required minimum distributions. Whether you want to take the money out or not, you're going to be forced to do that. And if you don't, it's a hefty penalty. So what we want to do is, can we implement a basic tax strategy here and see if we can save any income or any money in taxes? So here, if they made it, all right, these are just some hypothetical and some assumptions here. If they made it to the age of 95 in this particular case, they have a lifetime projected tax of almost $6 million. Do you see that right there? All right, so all I'm going to do in this example is I'm just going to do Roth conversions. I'm going to do about 5 years of Roth conversions. I'm not going to convert it all, just a portion of it, just to see if it helps improve the situation at all. But let's take a look. So when I do that, is I've drained down some qualified money here, and you can see the tax savings goes from $6 million down to the lifetime tax of about $3.6 million, saving $2.2 million in taxes. Now, it depends if that's great, but you have to do this very carefully and very safely, right? So once money gets moved into tax-free buckets, it's fantastic because you get tax-free growth, tax-free withdrawals, and you can push it to the inheritance or the loved ones tax-free as well, as long as you follow all of the rules. So all of those things are good. This family, maybe they don't care so much about leaving a huge legacy. So something similar to this, whether you want to leave money to loved ones, whether you don't care so much, someone's going to have to pay the tax on this. And if you believe at all that taxes in 10, 15, 20 years from now might be higher, then doing some conversions or tax planning is going to help you tremendously as you're going into retirement. So for this couple, it was income planning, investments, and tax planning. I hope this was helpful. I hope this gives you some ideas of the importance of and the benefits of what basic Roth conversions can do for you. It is not for everybody, but it's definitely something to take a look at and to rule out for you. I hope this was helpful, and as always, remember to consult a licensed professional who understands your specific goals and dreams.